Hi, this is Kerry Artak with Artak Advisory, and this is an AgriTalk video supplement for the week of Monday, February 1st. In it, I'm going to be covering three markets: March corn, April live cattle, and March heating oil. Before I jump into the charts, I just ask that if you haven't had a free trial in 6 months, or if you've never had a free trial at all, please go to the website. I know you're probably there already because you're watching this video. At the bottom of the AgriTalk page is a link for getting a free trial. And, you click that link and you fill out your first name, last name, email address, phone number, maybe a little bit about yourself, and I'll set you up with 2 full weeks, uninterrupted weeks of everything that I produce. I call you early in the free trial. We can talk the markets, talk about your needs, hedging needs, trading needs, any issues that may be recurring. And after the 2 weeks, I follow up with a phone call to see if you may like to become an active month-to-month subscriber. And there's no long-term commitments on subscription, by the way. So let's jump into the charts, starting with March corn. Back in late December, had a long-term buy signal that I have mentioned several times on the show. This long-term buy signal remains in effect above 465 half. 465 half is, by the way, our support really through the rest of the year. This longer term 4 or 5 year channel structure is now our floor of support, and above which, as I've been mentioning on the show, maintaining really kind of a 5 to 8 month objective in the 622 and 3/4 to 650 even area. 622 and 3/4 represents a complete objective in a sense because it is a full extension of the previous channel structure that the market had been trading in for some years. And so the full extension is 622 and 3/4. And this is a descending 2/3 speed line that is also a target. We did close above the descending 1/3 speed line when we settled above this 465 half channel top that last week of December. At that point in time, it was in the 458 half area. Upper 450s to mid 460s was our resistance that we settled above, now support. That descending 1/3 speed line, by the way, is well below the market in the very low 450s right now. I'm using 465 half as our floor through the rest of the year, and above which, as I say, this upper area remains our 5 to 8 month objective. Now, the way things are going, we're halfway there already, and we're about 4 or 5 weeks into this rally. And so there's every reason to consider the possibility that we may reach that 650 mark over the next 2 to 3 months perhaps. In fact, while 579 even, a 50% retracement from the 2012 high against the 2020 low, can contain buying into later, possibly through February trade, there's no reason to believe that we won't settle above it on the first attempt perhaps. Although I'm giving it its fair due in terms of its containment potential. It is roughly consistent right now. This is a daily chart, by the way, so this number is rising at a pretty aggressive rate. 575 half, we may reach that this week, and it merges with that 579 even long-term Fibonacci retracement level later in the week. It is equipped to contain, I'd say, weekly buying pressures at the very least, possibly into later February, and from here we could fall back to this channel support, which is presently in the 510s. Okay, that is a possibility. We could rotate, fall back into the 510s from the 570s. But let's go back to this chart here. I'll zoom in on this in post-production. This formation last week alone, the fact that we broke back to a new pullback low following the previous high a few weeks earlier, and then proceeded by the end of the week to rally and settle above all of these previous highs. That outside week bullish settlement above the previous highs is a sign of continued strength. It is a sign that we're likely to continue to this 579 even level, possibly. I almost said probably this week. And it could well be this week where we can tap out into later February. But closing above 579 even, we are only 2 to 3 weeks away from testing this target at 622 and 3/4, which is the start of a wide zone of narrowing resistance up to 650 even that can absorb buying through the balance of the year. I think that's all I'm going to say for corn. Let's jump into April live cattle. If you listen to the show, you know that for the last couple of weeks, I've been mentioning that we have settled above a long-term resistance area in April live cattle. This long-term weekly chart goes back 4 or 5 years. It is significant in its containment potential and its buy signal quality. So let me cut to the chase here. Yes, we have settled above this formation, but not by a 1% margin. And I do mention that in the show periodically. I mention it to my subscribers every single day at the end of every week that unless we close above this formation by a 1% margin, we are merely stretching the rubber band. The rubber band hasn't snapped yet, allowing bullish continuation over the months ahead. Until then, we are merely testing long-term resistance, despite the fact we've actually settled just above it for 2 weeks in a row. So, what am I saying? We do need to close above 121.67 at the end of this week by at least a 1% margin, which is at 122.87. So closing Friday, the week itself, above 122.87, the rubber band does snap, if you will, and I would expect bullish continuation over the months ahead. I will show you those targets in a second. But first, until then, as long as we cannot close above this formation by that 1% margin of 122.87, and certainly if we close this week, Friday, below 121.67, there's no other way for me to see that other than this market, the broader live cattle market, is highly susceptible to falling back over the weeks ahead, 3 to 5 weeks, 2 to 3 months, something like that, into the 108.90 to 110.15 region, which is a bit of a moving target, rising ever so gradually, but this area becomes realistic. I think you can just call it the 110 handle over the next few months, where the broader live cattle market can bottom out through spring trade. Now upside, closing above this 121.67 formation by at least a 1% margin, in other words, closing Friday at 122.87 or higher, does signal bullish continuation. I'm going to say 3 to 5 months. Could be sooner, could be 2 months or so. But I'm going to say by later spring, we should reach this 135.72 to 138.05 area, a long-term descending channel top that's based upon these lows. It is sort of the sister, if you will, to this intermediate channel structure, and a long-term descending 1/3 speed line that incorporates the 2014 low against the 2014 high rather, against the 2020 low. In any event, this area, if it is tested, doesn't become signaled, of course, unless we close Friday above what? Above 122.87, that 1% violation of 121.67. This area, 135.72 to 138.05, fully able to absorb buying through summer and even the balance of the year. Let's talk finally heating oil. March heating oil. Now, on the show a few months ago, I did mention a buy signal above this formation here, then indicating bullish continuation into the upper 1.60s. 1.6380 is the initial resistance, but really it's this convergence of this channel top coming up and this long-term descending 1/3 speed line that's projected off the 2008 high against the 2020 low. I know I talk about speed lines. I should probably show how they're constructed at some point, but they are well suited. They're dynamic. They're well suited for trend identification. And the bottom line is we are now in the process of testing long-term resistance. Ultimately, 1.6729 to 68.23 this week only. It changes every week. Can absorb buying into spring trade, and from here we can fall back into the very low 1.30 area, which I'll show you in a moment. But if we were to close above 1.6823 at the end of this week, and remember this is the March contract, then we have a sign secondary strength that should play out through spring. The next 3 to 5 months, possibly a summer high, 2.35. That would be the next target, and this formation well suited to absorb buying through the balance of the year. Now, if we do not take this area out, in other words, we're testing it now, and if it holds, this market, as I say, is likely to fall back. I'm going to erase this for the time being and just mention that this is this area that I'm telling you about, this rising channel top, this long-term descending 1/3 speed line. It comes in at 1.6729 to 68.23. From here, we can fall back to the channel bottom, presently 1.21. It merges in later March with the series of highs here at 1.3050. And so I'm going to say the upper 1.2s, very low 1.3s, are realistic over the coming months. And let me just reconstruct that very short-term channel bottom, this structure at 1.5686. 1.5686. If we close below 1.5686 March heating oil at the end of this week, then this rotation is begun, and this market is even more susceptible to falling back into this zone of support. I'm going to say over the next 2 to 3 months. So bottom line, with heating oil testing long-term resistance in the upper 1.6s, able to contain buying into possibly through spring. From here we can fall back into this zone over the next few months. And that is all I've got to say for this week's AgriTalk video supplement.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You've nothing to lose and much to gain.